Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Unlocking IPO Secrets, a guide to going public. Regulation and compliance in IPOs. When a company decides to go public through an initial public offering, IPO, it must adhere to various regulations and compliance standards set by regulatory bodies. In the United States, one of the primary entities overseeing IPOs is the Securities and Exchange Commission, SEC. Let's delve into the key requirements and legal responsibilities that companies must consider when embarking on the IPO journey. Securities and Exchange Commission, SEC, requirements. The SEC plays a crucial role in regulating the securities industry and protecting investors. Companies looking to go public must comply with SEC requirements to ensure transparency and fairness in the market. One of the fundamental steps in the IPO process is filing a registration statement with the SEC. This document provides essential information about the company's financials, management team, business model, and potential risks to investors. Additionally, companies need to work closely with underwriters and legal counsel to draft a prospectus that complies with SEC guidelines. The prospectus serves as a comprehensive disclosure document for potential investors, outlining the company's operations, financial performance, and future prospects. The SEC reviews these materials to safeguard investors from misleading or fraudulent information. Moreover, the SEC monitors the trading of newly issued shares to prevent market manipulation and insider trading. Companies must also adhere to ongoing reporting requirements, filing quarterly and annual reports to keep investors informed about their performance and any material changes in their business. Legal responsibilities of companies going public. Before going public, companies must understand the legal responsibilities that come with being a publicly traded entity. This includes complying with securities laws, such as the Securities Act of 1933 and the Securities Exchange Act of 1934, which regulate the issuance and trading of securities in the U.S. Companies must disclose relevant information to investors and the public in a timely and accurate manner. Failure to do so can lead to legal repercussions and damage the company's reputation. It's crucial for companies to establish robust internal controls and governance structures to ensure compliance with all legal and regulatory requirements. Furthermore, senior executives and board members have fiduciary duties to act in the best interests of shareholders. They must avoid conflicts of interest, maintain transparency in their dealings, and uphold ethical standards in their decision-making processes. In conclusion, navigating the regulatory landscape and fulfilling compliance obligations are essential aspects of the IPO process. By adhering to SEC requirements and understanding their legal responsibilities, companies can instill trust in investors and pave the way for a successful public offering. Key factors influencing IPO success. When considering the success of an initial public offering, IPO, several key factors come into play. Understanding the market conditions and timing, company valuation, as well as brand reputation and investor confidence are crucial elements that can significantly impact the outcome of an IPO. Market conditions and timing. The success of an IPO is highly dependent on the prevailing market conditions and the timing of the offering. A favorable market environment with strong investor demand and positive economic indicators can increase the chances of a successful IPO. Conversely, volatile market conditions or periods of economic uncertainty may deter investors and hinder the success of the offering. Timing the IPO to coincide with favorable market trends can optimize the outcome and attract potential investors. Company valuation. The valuation of the company going public is a critical factor influencing the success of an IPO. A company's valuation reflects its perceived worth in the eyes of investors and can impact the pricing of the shares offered during the IPO. An accurately assessed valuation that aligns with market expectations can enhance investor confidence and generate interest in the offering. Conversely, an inflated or undervalued company can deter investors and lead to a less successful IPO. Brand reputation and investor confidence. The reputation of the company preparing for an IPO and the level of investor confidence in its growth potential are essential factors for a successful offering. A company with a strong brand reputation, a track record of success, and a clear growth strategy is likely to attract more investors and generate greater interest in the IPO. Building investor confidence through transparent communication, solid financial performance, and a compelling business narrative can enhance the success of the IPO and support long-term investor support. In conclusion, a successful IPO is the result of a combination of factors, including market conditions, company valuation, and brand reputation. By carefully evaluating these key elements and ensuring alignment with investor expectations, companies can optimize their chances of a successful public offering. Going public through an initial public offering, IPO, is a transformative milestone for a company, marking its transition from a privately held entity to a publicly traded one. This process involves offering shares to the public for the first time, enabling the company to raise significant capital for growth, expansion, and other strategic purposes. Understanding the intricacies of an IPO can help both companies and investors navigate this complex journey effectively. An IPO provides companies with access to substantial financial resources, which can be used to fund new projects, enhance infrastructure, pay down debt, or support research and development. Additionally, being publicly traded can elevate a company's visibility and credibility, making it more attractive to customers, business partners, and top talent. However, the path to an IPO is rigorous, requiring meticulous planning, comprehensive preparation, and adherence to stringent regulatory requirements. The IPO process begins with the company selecting underwriters, usually investment banks, that will manage the offering. These underwriters are crucial as they provide expert advice, help determine the offering price, and facilitate the sale of shares. They also conduct due diligence to ensure that all information disclosed is accurate and complies with regulatory standards. Once the underwriters are in place, the company must prepare a detailed registration statement, including a prospectus, and file it with the relevant securities regulatory authority, such as the Securities and Exchange Commission, SEC, in the United States. The prospectus provides potential investors with essential information about the company, including its business model, financial statements, risk factors, and management team. This transparency is critical for building investor confidence and ensuring compliance with legal requirements. The due diligence process involves a thorough review of the company's financials, operations, and legal standing. This comprehensive scrutiny ensures that all information presented to investors is accurate and complete, and any discrepancies or issues discovered must be addressed before proceeding further. During the registration period, the company enters a quiet period, where communication with the public is restricted to avoid influencing the share price. During this time, the underwriters and the company's management team conduct a roadshow. This involves presenting the investment opportunity to institutional investors, analysts, and potential buyers. The roadshow is a critical component of the IPO process as it helps gauge investor interest and finalize the share price. Pricing the IPO is both an art and a science. The goal is to set a price that balances raising sufficient capital for the company and providing an attractive investment for new shareholders. If the price is set too high, it may deter investors and lead to a poor initial performance. Conversely, if it is set too low, the company may not raise as much capital as needed and leave money on the table. The underwriters play a key role in determining the optimal price, using their expertise and feedback from the roadshow. Once the pricing is finalized, the company's shares are officially listed on a public stock exchange, such as the New York Stock Exchange, NYSE, or NASDAQ. The first day of trading is often marked by high volatility as the market responds to the new listing. A successful IPO can result in a significant increase in the company's valuation and provides an opportunity for early investors and employees to realize some of their gains by selling their shares. For investors, participating in an IPO offers the chance to invest in a company at the ground level of its public journey. However, it is important to approach IPO investments with caution. Newly public companies can be volatile and may not have a long track record of profitability. Conducting thorough research, understanding the company's fundamentals, and assessing the risks involved are crucial steps in making informed investment decisions. Post-IPO, companies must comply with ongoing regulatory requirements, including regular financial reporting and disclosure obligations. This increased transparency can provide shareholders with valuable insights into the company's performance but also subjects the company to greater scrutiny from regulators, analysts, and the public. In conclusion, going public through an IPO is a complex and multifaceted process that offers significant opportunities and challenges for both companies and investors. For companies, it provides access to substantial capital and increased visibility, but requires rigorous preparation and compliance with regulatory standards. For investors, IPOs present opportunities to invest early in potentially high-growth companies, but come with risks that must be carefully evaluated. By understanding the IPO process, stakeholders can better navigate this significant financial event and capitalize on the opportunities it presents. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.